All right, guys, some exciting stuff. We're going to go over the new ETFs that Defiance is releasing, and that is going to be the daily paying ETFs. So they're going to be launching 3 daily paying ETFs, one on the NASDAQ 100, one on the S&P 500, and another on the Russell 2000. So some pretty popular indexes. I'm pretty glad that they're doing it on these big indexes. It does help diversify a lot, and we are kind of skeptical because Defiance is known for a lot of bad ETFs. They have Elon ETF there, but a lot of these income ETFs are not performing well. So we have QQQY, WDTE, IWMY, and all of these have been seeing some significant NAV erosion. As we can see, the price has been just dropping and it has not seen any recovery in the stock price, but they do have some that are pretty okay. I would say SPY T is a decent one. As we can see, year to date, is relatively stable between that $19 and $20 price range, and the target is 20%. So nothing crazy, a little bit more stable, but we're really looking forward to these new ETFs. So if we take a look at the prospectus, this is going to be their new lightning spread strategy. So what they're going to do is they're going to buy a long dated deep in the money call option on the index, and then they're also going to be writing put spreads, probably put credit spreads on the index every single day. So that's where they're getting the income from. They're going to get it from those put credit spreads, and it looks like they're going to pay out a portion of that credit to the investor. So keep in mind that these are both bullish positions. A put credit spread, you want the stock to be staying high, and you also want that long call option as a bullish position as well. So as we see here, we scroll down the index. It does seem like that we are going to have twice the risk of the downside. This is going to be a very volatile ETF because there's unlimited upside potential because of that long call option. And then we're also going to have double the downside risk because we're holding 2 bullish positions with that long call option and that put credit spread. So what does a put credit spread look like in Robinhood? We can go on the S&P 500, and basically you want to sell a put option at a higher strike price and then buy one at a lower strike price. So see in this example right here, we can sell a 596 put and then buy the 594 put, and that's going to give us a credit of $28. Now this does include a ton of risk. If the S&P 500 drops below our strike price of 594, we're going to be seeing a lot of losses from this put credit spread as well as that long call option. And if it goes in between the strikes at the end of the day, so say S&P 500 or SPY goes at $595 at the end of the day, we're going to be pinned between our strike prices, and we're going to be incurring a huge loss. So this is going to be a very risky ETF. Honestly, I'm going to be staying away. It doesn't seem like it's worth the trouble for daily dividends because of this strategy. It's going to be very volatile. And honestly, Defiance has been putting out ETFs left and right, like many companies, to try and capitalize on these expense ratios. This is likely going to have an expense ratio of 1% or even 1% or even over 1% because it's going to be actively managed, and they have to open and close these put credit spreads every single day. And honestly, the ones that are going to get rich are the fund managers themselves. That's why there's so many of these ETFs. So just be careful about that. But it is going to be interesting going forward what kind of competition they can have from other companies such as Roundhill or even YieldMax to see if they can also provide some daily dividend ETFs.